Welcome to Cotality's Housing Market Update for December 2025. Our National Home Value Index rose another 1% in November, marking the third month in a row where Australian home values have increased by 1% or more. However, the pace of growth eased a little bit over the month, coming down from 1.1% in October. The headline growth outcome was weighed down by Australia's two largest cities, with Sydney values rising 0.5% in November and Melbourne values up 0.3%. Every other capital city recorded a rise of at least 1% through the month, led by Perth with a solid 2.4% surge in values. These two-speed conditions are similar to the growth patterns seen through late 2023 and 2024, where the mid-sized capitals pulled away from the majors. The subtle easing in headline results comes as auction clearance rates have trended lower since peaking in mid-September, falling below the decade average by mid-November. Both Sydney and Melbourne have seen clearance rates hold around the low 60% range through the second half of November. Record levels of housing unaffordability are another factor, with affordability metrics to the September quarter showing a record high in the national dwelling value to household income ratio, where the median dwelling value is now 8.2 times higher than the annual pre-tax household income. Serviceability metrics are also near record highs, with 45% of gross household income required to service a mortgage at the median value. We can already see the flow-through effect from such stretched affordability and serviceability measures, with growth in housing values skewed towards the lower price points of the market. Over the past 3 months, most of the state capitals have seen housing values across the lower quartile of the market rising the fastest. Melbourne, where housing affordability isn't quite as stretched, is the one exception, with the city's broad middle of the market seeing the fastest lift in values. Rental markets remain extremely tight, with no sign of vacancy rates loosening. Nationally, the past 4 months have seen rental vacancy rates holding close to record lows at just 1.5%, down from 1.9% a year ago. With vacancy rates remaining low, rents are continuing to rise. The National Rental Index rose 0.5% in November to be 5% higher over the past 12 months. That's the highest rate of annual growth since the same time last year. The ongoing rise in rental costs is occurring against a backdrop of severe rental affordability pressures. The latest Cotality affordability metrics estimate that the cost of rent equated to just over 1/3 of a household's pre-tax income in September, a new record high. Sydney home values rose by 0.5 percentage points in November, well below the combined capitals benchmark, where values were up 1%. It's looking increasingly likely the Sydney market moved through a cyclical peak in the growth rate when values were up 0.9% in August. Since then, the pace of capital gains has eased, alongside a softening in the auction clearance rate, which was tracking in the low 60% range through the second half of the month. It's the upper quartile of the city marketplace that's dragging on price growth, with dwelling values unchanged in November, while lower quartile housing values were up 1%. Affordability and serviceability challenges are likely to be the key factor deflecting more demand towards affordable price points and dampening housing conditions overall. It seems that housing dynamics are becoming more complex from month to month. Downside factors include record levels of unaffordability, a growing expectation that interest rates will be held for an extended period of time, renewed cost of living pressures, and a fresh phase of macroprudential credit tightening in the form of limits on high debt-to-income ratio lending. On the other hand, persistently low supply levels across both the established market and newly built housing sector are continuing to drive prices higher. The federal government is stimulating first homebuyer demand via the expanded 5% deposit guarantee and a soon-to-be-released Help to Buy shared equity program. Credit growth for housing investment is also rocketing, rising at its fastest pace since December 2014. What's clear is the upside factors are continuing to outweigh the downside risks, and it's hard to see this dynamic moving into reverse anytime soon. Time will tell whether this month's subtle slowdown in growth is a reflection of headwinds starting to curtail the housing tailwinds. With housing values rising at more than twice the pace of wages growth, housing affordability is set to worsen. Serviceability barriers are likely to deflect more demand towards the lower price points of the market, with mainstream buyers on a median income crowding out lower-income households at the more affordable end of the pricing spectrum. Stable interest rates will exacerbate the serviceability challenge, with the recent increases to borrowing capacity already eroded by higher housing prices. While borrowing capacity for the median household income has increased by around $55,000 since the high point of mortgage rates, the national median dwelling value has already increased by about $60,000. Over time, rising serviceability barriers are likely to limit the magnitude of home value growth as credit becomes less available. Clearly, APRA's on watch for rising levels of household debt. Any sign of a slip in underwriting standards could be met with additional credit constraints. The recently announced 20% limit on high debt-to-income ratio lending isn't likely to play a significant role in slowing down price growth, but it does send a clear message that APRA is on alert. A more overt policy adjustment, such as lower limits on high DTI lending or a renewed investment credit growth speed limit, if implemented, would have a much more substantial impact, especially at a time when investors comprise around 41% of home lending. Low supply levels will inherently take some time to fix, especially with labour supplies so scarce and ongoing competition for inputs from the public infrastructure sector. Construction costs are no longer rising rapidly, but they're not falling either. Builder profit margins remain compressed, especially across the multi-unit sector. Overall, we're expecting housing values to continue rising through 2026, but the pace of gains is likely to slow down as affordability and serviceability factors put a ceiling on how high housing prices can go. Seasonally, we've already seen a peak in listings activity, and market activity will slow further through December and into January. Cotality will be continuing to publish our market updates, so stay tuned to the insights pages of the Cotality website. As we wind out 2025, I'd like to wish everybody a very merry festive season and a sincere best wishes for the coming year.